Well, hello and welcome to the 27th Degree with Chris and Nancy. Today, we welcome back Mike Taveira from BayCoast Bank. Did I get your name right there, Mike?
Michael Taveira, yeah.
All right, great. To discuss credit scores. Before we begin our conversation, I'd like to thank our sponsor, BayCoast Bank. BayCoast Bank is just right for all of your financial needs. Visit baycoast.bank or call 508-678-7641 to learn more. As always, you can support the 27 Degree with Chris and Nancy by subscribing to us on YouTube or your favorite podcast platform and by following us on Facebook and Instagram. Also, please remember to leave a review. And of course, 5-star reviews are greatly appreciated. So, Mike, let's start. Tell us a little bit about yourself, and then we'll get into credit.
Absolutely. I've been in mortgages and lending for 15 years. The last 6 or 7 of those with BayCoast Bank. We're a subsidiary of BayCoast Bank. I'm actually working for BayCoast Mortgage Company. BayCoast Bank was a bank started in 1851 in Tiverton, so everybody knows us locally.
Right.
I've been in this space for over 15 years, like I've said, so mortgage lending and that side of things is my specialty.
You know, I'm going to go kind of away from what we're talking about here today, but I learned some really interesting stuff about BayCoast Bank's history.
I like that.
Yes, that Lizzie Borden's father was, I think, like president of the bank before it was BayCoast, obviously, way back in the 1800s.
Wow. Okay.
I heard that now.
Well, we used to be Citizens Union.
Yes.
So,
yes.
yeah. Wow.
So you're kind of setting us up for our Halloween October podcast mentioning Lizzie Borden.
I think it was
it's
her
a little
father.
teaser.
You'll have to confirm that. I'll have to do a retraction if I'm wrong, but I don't think I am, actually.
I mean, I'll have to brush up on my history with that, but I actually am interested in that whole Lizzie Borden whole story, but I did not know that.
Right. Well, that's a good, like you say, kind of preparation for our Halloween show, whatever that might be this year. But before we get into some really specific questions about credit, can you tell our audience, why does credit even matter?
Well, honestly, it's one of the most important things. It's actually, I tell to people that it's priceless because things are so much more expensive when you don't take care of your credit score. So not even just buying a home or going, a lot of our stuff is going to be geared towards the mortgage aspect of it. But I will touch on a lot of like auto loans and credit cards. And it really is everything now. Insurance is impacted. There's just so many things that with a good credit score, you don't have to worry about. And over time, everybody needs to finance something, whether it be student loans or recreational vehicles or whatever it may be. The interest rate could be as much as double if you have a credit score in the low 6s rather than the mid 7s. So it gets a lot more expensive. Like people look at the inflation and how much things cost right now, and they're like baffled by it. It's only compounded even more with a bad credit score. So not only are things the most expensive they've ever been, it's really impacting the people with lower credit scores because their prices are going even higher.
So if they go for a mortgage or a car loan, the big ticket items.
Yep. I mean, that's where you're really going to feel the hurt the most because with rates, without getting specific with rate, because I don't know exactly the date that will be on, but rates are at pretty much a 15-year high right now. So with a lower credit score, you always see there could be variations of like a point to a point and a half, depending on your actual credit score if it's really bad. Imagine having almost all-time high rates in the past 15 years and then paying the price for your credit score. It's just something that it's too much of a pain point right now, especially for first-time home buyers who weren't coached correctly in school or college or by parents or whatever it was. And then they might see their credit score for the first time and be like, what? They don't even know. But luckily, there are more ways to figure out your credit score and be more credit savvy. And I think that's what we're going to talk about today, which would be great.
That sounds great.
Can you begin the conversation by just kind of talking a little bit and defining what a credit score is and kind of like what goes into it and how do you get a credit score?
Yeah, absolutely. So the way I coach this, I kind of break it down to where almost an elementary level when I'm talking to first-time home buyers or any buyers where I try to describe it as like a picture. So your score is a snapshot of your credit at that one moment in time. But credit is formed over a long period of time. So as you can't, even though you're frustrated and your score may be low, it's not something that's going to instantly be fixed. So because it took you a while to get to that bad spot, or it took you a while to get to that good spot, it's how your credit worthiness or how you utilize credit over a long period of time. So it could be years, but if you're young, it could be just a 2 or 3 year snapshot of you had your first debit card or credit card or a bill that gets reported to credit, whether it be a car loan. Now, it's going to be weighted more heavily when you're so young because your only loan might be that auto loan. So if you miss that payment and your snapshot of your credit history is only a year or two, it's heavily impacted. So your score is going to be low if you are late because your picture over time isn't big.
So that makes sense because you don't have a lot to draw from.
No.
So that's the whole shebang.
Yeah.
So if you miss a payment, it's you're going to plummet a little bit.
I almost try to bring it to a real world scenario. Like if I'm 19 and I ask you to borrow money and you're a friend, but you're not a family member, and you're like, I know you missed that bill. I know you missed your cell phone bill twice in the past 2 years. You talked about how expensive it is. And you're like, what's the chances this person gives me my money back? And that's what a credit score is. Makes essentially sense. Is the likeliness of that person to pay the creditor back. And it's represented in a score. So if you could have someone score above their head when they ask you to borrow money, just picture that.
Oh my God, that would be kind of scary. Yeah. I have to tell you a story. I had borrowed money from my brother once when I bought my house 20 years ago, and it was $2,000. I think I'm like, can I borrow the closing costs a month? And I figured in, right? And he's like, yeah, no problem. You know what he made me do though? Because he's very financially
Signed
savvy.
an affidavit?
No, he made me write out checks.
Wow.
So we paid him back, I don't know, $200 every week.
You wrote them all up front.
I had to write them all up front and give him the pack of checks. So and then I knew he would be cashing that $200 check for the next 10 weeks.
That's definitely...
That's a way. That's a way of doing it.
We'll call it thorough because he might be watching. But I like his style because
I like that.
Yeah.
So he really trusts you.
Yeah. Well, he loves me. No, I'm serious.
Did he ask you what your credit score was?
No, he adores me. He loves me, but he's very savvy financially. And then you knew that it was a financial contract, not just oh yeah, next week, Yeah,
because nothing puts stress on a family or friend relationship than seeing that person. And then they owe you money, and then you see what they're doing in their life and posting on social media.
Oh, you went on a vacation. Where's my $200?
Yeah.
Right.
And you don't want that to ever happen. So that's why it becomes a tough situation like that. But imagine if your creditors could do that. Be like, oh, you went on a $6,000 vacation, but your mortgage payments is 14 days late.
I know. You got your eyelashes done.
Exactly. But no, that's the best way I can represent it or define it to somebody who needs to understand credit, especially a first-time home buyer.
So how is a credit score created? Is it the money that you have in the bank? Is it how much you earn, or is it just your risk?
So the common misconception is both of those. Those have nothing to do with your credit score. It's your earnings and what you have in the bank, because the credit companies can't know either of those two. Your actual employer is listed at the bottom as public information, but they don't know your salary or what you make, and they can't make your judgment off that. So it's strictly your bills and your open credit lines, and what their balances are, and not what you earn or what you have in the bank or anything like that. So it really is stressing what you pay back on time over a long period of time. So if you're always hitting your payments, your score will incrementally rise very slowly, but it'll go 720, 730 over years of time. That's why some of the only 800 credit scores that I see are people in at least 40, 45 years old, because while someone can have a 760, 780 credit score at 25, 30 years old, it takes a little while to build it to that high of a level, because the highest score is 850, the lowest is 300. The lowest I've ever seen, personally, I probably pull 7 to 10 credit reports. Well, it used to be a day. Now it's probably every couple days. But the lowest I've ever seen is probably 400, 420. And that you have to really work hard to get it down to that level.
Yeah.
But if
is that after a bankruptcy?
That would impact it the most. Foreclosure would, and then tax liens from like income tax or whatever.
Yeah.
They'll report tax liens or judgments against you. So you could have a laundry list of that stuff going on that isn't even your actual bills.
Right.
But judgments and tax liens will stay there until they're released, and then they'll stay at the bottom of your credit report, even paid for that 7-year period.
Wow.
Yep.
So, you know what I like about that, though, is it really levels a playing field. So, like the guy who's making 30 grand a year or 25 grand a year, you know, he still has a great chance of having a great score compared to a doctor who might be making like the big bucks and stuff. It's like, it just makes it fair, makes it even.
It comes down to financial responsibility, because I have some of my highest earning clients that purchase homes that are their credit report is riddled with 30-day lates because they have 5 open store cards with a $40 balance that they're like, oh, that must have came in the mail or whatever. It's being organized and diligent on having the auto pay or paying it on time. There's people that have a great credit score that earn 30 grand a year, but they have 3 trade lines and they always pay them on time. And that's really doesn't have anything. Some of the lowest credit scores I see are some of the people that earn the most money.
Right.
Yeah.
It's just there's so much going on in their lives a lot of the time, especially if they own a business or something like that. It's just they probably get pieces of mail stacked every day. So if they're not going through that daily, it's easy to miss a 30-day late there.
Right.
So it's almost you tracking your own stuff, whether it be on Excel or having auto pays or whatever it is. It's not having debt, because having debt and doing it responsibly, which is keeping the balance under about 30% of what you're allowed to borrow on the card, is going to give you the highest credit score, because the credit bureau and the credit card company, that's how you're utilizing credit correctly. Is you're not maxing it out and you're not keeping it at 0, because you're really not using credit at all. So it's not helping your credit score if you keep it at 0. But if you keep it, if it's $1,000 limit, you keep it at $200 and you're making minimum payments and it stays between $200 and $300 the balance. Even if you want to pay it off monthly, you could do that also, because you don't know when once a month that credit card company is reporting to the bureau. So you're going to always probably have a balance on it, but it's just don't do it over 20 or 30%, and you're going to see your credit score start to rise.
Are you better to pay off the monthly balance every month fully from a credit perspective? Or is it okay to leave a little bit there? I know you pay high interest rates when you do that, potentially.
So for credit, if your objective is to get your credit score as high as possible, you would want to leave a small balance, because you want to show that you're keeping that 20 or 30% balance and not maxing it out. So that will help your score the most. I can speak from what I do personally, and I pay it off monthly because I don't want to pay them 21% or whatever it is.
I do too. That's my feeling also. I didn't know if that affected my credit adversely, though.
So it won't be adversely, but you won't get credit for like your credit score is not going to rise dramatically, but it's not hurting you at all. So I'd rather, if my credit score is still very good, so I don't need that boost, and I don't want to pay them interest. So that's why I just pay it off monthly, and the points are great.
So when you go to a bank to get a mortgage on a home, for example, they have set rates. You know, if you do a 30-year fixed, it's at this rate and whatever. But are you saying that you might get better rates if you have a better credit score, or just
absolutely.
You may not even get a mortgage if you have a bad score, or a little bit of both?
Exactly. It's actually a little bit of both. So there are minimums as far as loan program. By far, FHA is the most lenient mortgage program that'll let you go down as low as 580.
Okay.
So you look at someone's credit report, it might be 580 for a reason. It could be one event, and they're a younger person, and credit score could easily rebound. They still deserve a mortgage. They just don't have. They had 2 trade lines, and one of them's late or was late in the past couple months. So it's something where they're still, and you're getting a little bit higher rate for a lower credit score. So it's. With FHA, it's not a drastic difference, but it is a bit of a difference. Conventional, when you're doing a conventional loan, which you can put as little as 3 or 5% down, they reward you for a great credit score. So you'll get the best interest rate, and your PMI will be very low if it's a better score. If it's a worse score, your rate's they really punish you for having a lower score, and the PMI monthly will exponentially be way more, because there's a mortgage insurance company that
and
is
that's what
assessing the
PMI
risk
is.
also. Yeah.
That's your mortgage insurance.
Yeah.
Okay.
So it's protecting the lender, and someone with a lower credit score is a bigger risk. So if they're putting less than 20% down and they have a lower credit score, the PMI monthly is going to be higher because they're higher risk.
Higher risk for defaulting.
Yes.
But if someone has a very good credit score, they're going to get a lower PMI potentially,
Much lower.
particularly if they put more money down.
Yep.
But are you also saying they may get a better rate on their mortgage also?
Yes. So if you have a better credit score, it'll definitely benefit you on rate and most on PMI.
And that's with most things, right? Like when I go get my car loan and stuff, it's like, if your credit score falls here, you're at this rate. If it falls here, you're at this rate.
Yep.
And then people at the lower rate.
Just to give you kind of a real life example, I had two different clients. They both had pretty much the same parameters on what they were putting down, the purchase price of the home, everything. One's credit score was like 635 and one was 740. The person who had the higher credit score, the PMI was about $84 a month, and the other person's was like $510.
Wow, that's a huge difference.
Are you serious?
Because PMI below 640 is an astronomical amount conventionally.
That's like a deal breaker.
Oh yeah. So I had to switch that person to an FHA loan, because on FHA everybody gets the same PMI.
Okay.
Because they're more lenient as far as credit score. So that person, the two clients, they both wanted to go conventional, but the lower credit score, I was like, your payment's going to be $300-$400 lower FHA, because they have a set standard for how much the PMI is monthly. So it was a no-brainer for them to go. And I was like, once you get your credit up, I coached them through how to get their credit up, gave them the list that I do all my clients. They're going to get it up, and then chances are you're going to refi anyways out of the rates that are in right now. So I was like, once you work on it, when it's time to refi, because we're going to refi out of this, whatever, 7% or whatever it is, down to hopefully when the rates come back, they're in the 5s or 4s or wherever they are. It's going to make sense for the refi, and you're going to be in the best position with the best credit score. So we'll switch it back over to conventional, and you'll get rewarded lower PMI and a better rate.
So, and FHA stands for?
Federal Housing Administration.
Okay.
Yep.
And then as far as those two, that example that you gave us with the two different credit scores, I understand that, one got a better rate on their insurance for their home.
Well, that was PMI.
PMI.
So I don't know too much about I know about insurance.
Yeah.
I can't speak to if premiums change.
Yeah, I was actually referring more to the PMI,
okay. Gotcha.
The mortgage insurance. But how about the actual rate for the homes? One had to go into a different type of loan, it sounds like. But if they had both stayed in the same
it was about a
type
half
of loan,
a point difference.
About a half a point?
Yeah, and on the bigger loan amounts now, because a starter home is $400,000
There's
as
nothing
a loan amount.
inexpensive anymore.
No, nothing. And so the half a point, while it doesn't, it's still a bit of a difference, and the person deserved a better rate with the better credit score. That half a point really could be over $110, $120 a month, depending on the loan size. So it's a lot. Over the overall value of that better credit score was almost $500, $600, $700 a month.
Interesting.
Yeah.
Just to cap off the mortgage kind of conversation, I just wanted to let everyone know that you have something unique too at BayCoast with refinancing, that you don't have to pay closing costs if you refinance within 2 years.
Yeah. So what we do, it's basically, the idea behind it is everybody buying at this point in time right now, and has for the last 6 months, that was closing with us, we want you to stay with us. We want to service the loan. We want you to be our customer for 30 years. We realize in 12 to 24 months, you're going to probably look, when rates come back down, you're going to shop and see where you can refi. So our idea basically was at BayCoast Mortgage, how do we get these people to stay our customer, because we want them as customers. We don't want to be just a year loan or a 2-year loan and then they leave for a better rate, which we usually almost always have the best rate. So we incentivized it where if you refi with us and the rates come down in the first 24 months of that mortgage, we'll pay the $2,500 of your closing costs to stay with BayCoast and grab a lower fixed rate.
That's awesome.
Yep.
Primacare is Southeastern New England's trusted leader in medical care. With offices in Fall River and surrounding communities, we're dedicated to your well-being. Our carefully selected team of more than 150 providers offers world-class primary and specialty medical care. PrimaCare doctors are supported by a skilled staff trained to deliver comprehensive radiology, imaging, and testing services. PrimaCare is large enough to take care of all your medical needs, but small enough to care for you personally. PrimaCare is by your side.
So getting back to the credit score specifically, we talked about it's kind of a level playing field where it doesn't look at bank accounts, your amount that you have in the bank account or your earning power. It's really your reliability and your responsibility towards your finances and paying your loans on time. So they look at that. They look at when they're creating a score for you, those people out there, when they're creating a score for you, they're looking at your financial responsibility. Are you paying your bills on time? Then other aspects that they look at, I imagine, is you had mentioned your length of credit history.
Yep.
And then does a diverse kind of debt portfolio help you out?
Yeah, I mean, I kind of like to split it up in a pie. It's around 30% of like your past history of your accounts. About 30% is the balances that you keep with those accounts. And then about 15 to 20% of the pie is like your most recent history, because that is, while it's not the whole picture, it's very telling at your situation in the past year, and it's weighted a little more heavily because you could have been very financially stable and lost your job 12 months ago, and now things are getting rocky. So it's like your current but like how your situation is right now, how your ability to pay the bills with your employment, or clearly there's some life scenario if the bankruptcy is something in the recent past. So it's going to be weighted more heavily. It's harder to get away from. The more time you get away from the bankruptcy or a big event like that, the score can start to rise, but right after is just tough because it's taking account and weighting the most recent couple months of your actual history. And then very small percentages of the pie are how you're looking for accounts. Are you looking to open all these accounts? Like, have you had 10 creditors for an auto loan and a mortgage loan and a credit card? Are you trying to get credit in all different ways?
Right.
So inquiries piling up is a factor in that. Now, I want to stress, because that's the question and the biggest hurdle I run into is like, I want to get pre-approved, but I don't want you to pull my credit.
Right.
So I say, all right, this is a great analogy for you. I say, that's like me going to the doctor and being like, can you tell me what's wrong, but don't touch me and don't
draw my blood.
I'm not going to tell you.
No testing.
I'm not going to tell you
No
what's wrong with
exam.
me. Can you just look at me and tell me if I'm good?
Right.
And like, so that's how I say it to someone. I'm like, if you go to the doctor and you don't give him any info and you're not going to let him examine you, how are we going to pre-approve you? So they're like, I don't want you to pull my credit. So the reason that they think that is because they were fed information, which is semi-correct, but not totally, that if you have people pull your credit, it lowers your score. So
I've always heard that, but
I've always heard that too.
the thing that it is technically correct, but it's not, because the auto industry and the mortgage industry have set forth, let's call it fair credit reporting, where you had people in the past, this was years ago, where they didn't want you to shop. So if you were already banking with a mortgage lender, or you had a bank company that was going to give you an auto loan, they were like, don't have a million people pull your credit because they don't want to get shopped. You know what I mean? Right. Now, if you have 4 or 5 inquiries, it comes up on your credit report as what industry it's in, mortgages. Oh. So when you have 4 different lenders, it's an encouragement to shop. It's not going to hit your credit every time. They actually view it as one industry pull. So it'll show, it's very obvious you're searching for an interest rate. So it will impact you like a point or two, but it's not going to be like 40 every points. Time I'm going to lose 5 points or whatever they think. Okay. So I'm not going to have 5 lenders because I'm going to lose 25 points.
That's really minimal.
Yeah. So over like a 45 to 60 day period, if you do your shopping in a very small amount of time, it'll just be one pull as an industry.
That's good
that it'll look like on your credit report, and the algorithm takes that into account. But it doesn't work if you're going mortgage company, auto loan, credit card. So you have 3 different industries, especially if you do an auto and a credit card at the same time, because as you know, when you walk into a dealership, they like, oh, let's try to get your best payment. And then 10 people pull your credit because they have 10 banks. You know what I mean? That they want to get you the best deal, but they don't care what your credit score is after 10 banks pull your credit. So it comes down to allowing it to happen in one industry. Don't really like if you're gonna do a mortgage, I would try to shop that in a small amount of time. Stick with your lender that you're comfortable with and that gave you obviously a fair, accurate deal. Mm-hmm. And then maybe not shop for a car while you're shopping. If necessity happens, it happens. Like people need a car and they got to go out and get it, but try to keep it to a minimum in the same industry, not back to back.
So, every place you go, do you want our credit card? They always want to give you their credit card. We'll give you this deal and you'll get 20% off or whatever for the first, week or whatever it is. I would think having all these credit cards is not necessarily good. Am I right?
Correct. Well, then the negative part about it is because those are the toughest ones to keep up. Like that one missed payment is, I didn't even shop at Kohl's for the past oh no. That's where I think the negativity comes in. And their credit limits are usually a lot lower. So if you buy something, it's going to be more than 30% sometimes of what you're allowed to borrow.
Yeah.
So if you keep that balance, it's more than 30% usually because it's not an Amex where you're going to have 20 grand.
Right.
It's going to be 300 at Kohl's, 500 at Express or whatever it is. And a lot of people will be like, all right, I'm buying clothes for my kid for back to school. And they'll spend $400 or $500 or whatever it is. And at Kohl's, they don't usually give big limits unless you've been with them forever and they just keep upping it.
Right.
So they do want you to spend, but they don't care how it impacts your credit score. So that's where the negativity comes in. But if you're paying it and being reasonable like any other one, it's tougher when you have more out there. So it's like 10 different stores. Your life is busy every day. Maybe you have an authorized user as a kid who's shopping for something and you don't even know. You know what I mean? So it's like there's a lot you could open yourself up to seeing your credit score get hurt by it.
So what's the difference between the soft and the hard inquiries?
So that's honestly for like the past 10, 15 years, that's been our biggest like education piece to people is like, is this a soft pull or a hard pull is like one of the questions that which is a great question. That means I know the person is really like either shopping or they are afraid of their score, whether it be very high or very low. They don't want it to be impacted to where they can't get a loan if it's low. They don't want it to ever come down if it's super high. So I talk to them and really it comes down to this is the best way to look at it. If you're applying for something, it's always a hard inquiry. It's never going to be a soft inquiry. A soft inquiry is really only how a credit card company checks if you're eligible for a card they're already gonna mail you or you know what I mean?
It's like at the register if they're like, do you want to sign up? Like you're at Marshall's and they're like,
that would be a hard inquiry.
That's a hard inquiry.
Yeah, so you'll see, but if Capital One wants to market you,
I see. You've already pre-approved or something?
Yeah, you're pre-approved for this offer.
Okay.
They didn't talk to you, so you could not have an hard inquiry, but they have some information that says you're pretty much almost eligible. Like they're very confident because they're using direct mail or email or whatever it is to send you a card that's like at a lower intro rate, or they want you to transfer a balance to them. Like they want that really bad. So they pay a lot of money for that information in those lists. So those are soft inquiries. So that you don't ever see those on your end. And if you have an app that tracks it, you'll never really see those unless it's a hard inquiry. But you would be initiating that application.
Okay.
For the hard inquiry.
So we did it again.
I love it.
All right. So we've got 3 credit bureaus?
Yep.
TransUnion,
TransUnion, and Equifax.
Okay. First of all, why do we need 3?
That's a great question.
It is a good question.
Yeah, Mike. Why do we need 3?
I like to call it checks and balances.
Okay.
So if there's some accounts that get reported to one bureau and not the other 2.
Okay.
So when you look at your credit worthiness, as a mortgage lender, we always look at whatever score lands in the middle. So if your Experian's 720, your TransUnion's 680, and your other one's 500, 500 gets thrown out. We're using the middle 680.
Do you see that kind of wide?
So the biggest you'll see discrepancies like that only when the creditor is like a collection agency or some not sketchy. I shouldn't say sketchy. Some smaller entity or whatever they don't, because you have to pay the credit bureau to put something on someone's credit. So if it's a collection, they don't want to pay all 3 bureaus. They know it's going to be a hindrance to you if they put it on one of them.
Right.
So that's why you may see a score discrepancy on one. It'll usually be a negatively something negative on it,
Yeah.
and it'll only be on one bureau because they have to keep reporting it. You know what I mean? So they don't want to pay 3. They can just do a third of the price and pay one agency. Yep.
That's interesting. And the bureaus, how do they make their money? I think you just alluded to this.
Yeah. So it's kind of like So we pay as a lender, we're paying for credit reports.
Okay.
Usually you'll pay like a third party to gather and make it one nice, neat report for all 3 of them. But it's like anything else. It's advertising, experience, people trying to track their credit scores, trying to get credit help or whatever it may be.
I noticed they have all these little side businesses now like that. Yeah.
Yeah. And like they are great tools. You just can't take them to heart. Like I never want to talk bad about any special app or any company that does that. It's a great tool to keep up with on your credit report. I think right now there's a lot of bad things that have come from like people breaching certain companies and losing information. One of the positives is you never really used to have too much access to your credit report on like a monthly basis or like the score. And now you do. You're almost alerted immediately on some things in some apps. So I think that's helped because you're not surprised at where your score is now. In the past 10, 15 years ago, people had no clue. They would go months without knowing because they didn't apply for new credit. You know what I mean?
So there's some value in that. You get that feedback and you can really adjust your behavior based on what you're seeing.
For sure.
It's kind of like, in the medical field, I'll bring it back to medicine.
Oh my God, go ahead.
No, let's just talk about this for a second because I think it's really interesting. So diabetes, for example, right? Now we have these sensors that you see people wearing on their arm. And, you can check your blood sugar 500 times a day if you want.
Yeah.
But I have patients who never were able to get their blood sugars under control, and now they get this immediate feedback and they can do it.
Oh, wow.
So it's
helps
kind
you
of
form habits.
So if you didn't have access to your credit report before, you could never really affect any behavior to improve it. Now you have these, options where you can check it 20 times a day if you want. I don't know why you would, but
instant gratification of like that or positive feedback
so
that you're doing.
It's a similar process.
Yep.
Yeah,
How close are those scores? Like on some of the more popular apps?
It's close. I always tell people it's gonna probably be within like 25 points.
Okay.
They're all using different algorithms, so that's never gonna be exact. But they've created an algorithm that closely mirrors what a credit bureau would do, and then they're using that to alert you or email you or notify you on your phone. And then the credit card companies are paying those apps so that's why it's free because they get free advertising on their app. And they say, let's stick 10 of our cards and say people are qualified because of their credit score, but only show this to people over 720. It's an easy way to target people.
Interesting.
Isn't it?
So they're getting information from credit card companies. Or getting it probably, I'm thinking, from when you pay your electric bill or your gas bill. If you're
Are
late,
utilities on there?
No, they're not.
So
if you're late or you don't pay it,
while. Yeah, it would take a while.
It would take a while.
But once it gets,
because that would be like collections.
Yeah, because you can't essentially you can't shut somebody off anymore. So probably hit your credit report before they shut it off.
Okay, all right.
But it would take a while for a utility company to do that, and it usually is a situation where you moved out of somewhere.
Yeah.
And then the landlord didn't pay it or something like that, and then they're only they just throw it on there as a hindrance because somebody's needs to pay it, or else it's just never gonna get paid.
All right. So instead of assuming, maybe you should tell us where they're getting all their information.
Well, so those apps have access to your credit lines because they're affiliated with your credit report. You know what I mean? So essentially, they have, like, if you used one of them, you could see your balances going down and what accounts you have and how many inquiries you've had in the past, 90 days. So that information helps them acquire and give you a score because their algorithm that they created, not the credit bureaus, is showing you a score. So they can see like monthly change based on their own algorithm, and it'll send you an email and say, hey, your credit score went up, which is probably a high success rate of people clicking on that email. And usually you would never click on that email.
Right.
So then now you're on their app. Once you're on their app, then you're looking, you're like, oh, wow, that credit card's less of an interest rate and gets more points than the one I have. I should balance transfer or whatever motivates somebody to spend less money on interest is really their main goal. And then they get it from advertising, but it's all one vicious circle.
Mike, when you talked about the 30% that you should keep your credit card balance under, is it like for each card or cumulatively? Like if I have a Kohl's and it's like $275 out of a $300 balance, but like when you put my 5 cards together, I'm under the 30%. Does it matter?
Yeah, you want to keep it for each individual thing.
Oh, it does.
It does show you your ability to how much you have access to as far as credit, but it's not judging you off totals. It's each line. Yeah.
What you're saying is if you I want to understand this correctly. If you have a credit limit on your credit card, let's say it's $1,000, you don't want to spend more than $300.
You want to keep the balance at or just below that $300 mark. It's not the end of the world if you go over that. You just don't want to get close to the max. It'll be really bad.
Are you talking about the balance that you let ride if you do that? Okay.
Yep. Yeah.
So in any given month, I mean, if it's $1,000 balance and you spend $900, but you pay it off at the end of the month, that doesn't matter?
So here's the thing. You don't know when each individual company reports to the credit bureau.
Okay.
So it's always a different day. So you might spend $900 and then a week later you paid it off, but they reported to the credit bureau on the 20th of every month.
Okay.
And if you carried a balance, it looks like you have $900.
So how about, some of these credit cards now, they have apps. They're really nifty. You can go on them and you can pay off, a little bit every day if you want, or make 10 payments in a month. Does that help you out?
Yeah, it's all about that running balance. So if you're making multiple payments per month and you're staying with that, overall, the importance is the balance. So if you pay it down to 0, it's not going to negatively affect you. That's great. But if you do keep that running balance of 20 to 30%, that's what's really going to help you, especially as a younger person, get that credit score up quickly.
Okay, so 20 to 30%, but then hopefully pay it off when it's due. And
you never want to give them interest for no reason for a little bit better credit score, but it's not going to negatively affect you. But if you can keep a running balance and you're going to keep one anyways, just do it at that. Try to aim for that mark.
Okay.
Yeah.
Okay.
I'm going to ask you to help me with a little math.
Okay.
Are you ready? So I'm at Home Depot and I'm spending like $2,000 and they're like, hey, get my card. You get 20% off this purchase. And I'm like, great. That's like $400. Did I do that right?
Yeah.
So $400. Yes. But then I don't pay my credit card off and I carry that balance for like 2 months.
Yeah.
Did I just like
your balance, your monthly payment and the interest you're going to pay for those 2 months is going to be less than your savings. But you should pay it off as quick as you possibly can, cuz that Home Depot credit card is probably above 20%. So
say and I don't know what Home Depot's credit card interest rate is, but say it's 25%. Like at what point are you like, I just broke even on this deal? And
it's within probably 3 or 4 months. Yeah.
Okay.
So it's like, it's going to come quick because the payment's not going to be very small and it's going to be all interest. There's no principal. And if you're making the payment, just the minimum, it's just interest. So let's say the payment is $100. For the first 3 months, you've saved $400, but now you've already paid $300 in interest to them.
Yeah.
You know what I mean?
So can I ask you a really unenlightened question?
No, that's fine.
So
this is good. This is why we do this.
So I have a $1,000 balance on a $2,000 credit card. And if I only pay $100 a month, that balance every time it cycles through that 25% interest rate.
Yeah.
So
it should stay that your payment or your balance.
So my couch that I bought is getting interest hit on it like every single month.
Well, usually when you're like a lot of furniture stores will have 0 interest for a while. So those are the ones to go with. That's when you finance furniture. But once you're out of that intro period or whatever it is, you should pay it off. You use their money for a while. If it's 0 interest, that it makes total sense.
Yeah.
But if you watch and read the actual finance agreement, when it snaps out of 0, it's gonna be very high.
You know what I've noticed? So we just switched over to a 0% card for like 15 months.
Yep.
But there was a fee to transfer your balance.
Yeah. Yep.
So I was like, ooh, that was a little sneaky because I don't remember them having those fees necessarily.
Because the credit card company loves getting more of your debt. But they also they want to keep the debt. They don't want you to get another offer in the mail in 6 months and then your debt's gone.
So now you feel right because you're not going to pay that.
If it's 0 interest,
so
they haven't made
They're
anything.
So smart.
Yeah.
Well, I'll tell you, we have a lot more to talk about. So why don't we finish this up, but then we're going to stay tuned for part 2. So this will become a 2-part series from BayCoast on credit and credit repair.
Sounds great. So once again, everyone, thank you for watching our show. If you'd like to become a sponsor, please contact us at 774-319-4230. And special thanks to Ron Gamache for our intro music, and the BioSkills of Northeast for producing our show, and of course BayCoast Bank, which is just right for all of your financial needs. Visit baycoast.bank or call 508-678-7641 to learn more. And we'll be back with part 2 soon.
Can't wait.